After studying this module, we shall be able to understand the meaning of incentives and incentive schemes, know the prerequisites for a sound incentive system, learn the types of incentive schemes, identify different types of individual incentive schemes, team-based incentive schemes, and organization-wise incentive schemes. Understand non-financial incentives. Know the types of non-financial incentives in brief and the differences in non-financial incentives across generations.
In the words of George R. Terry, incentive means something that incites or has a tendency to incite action. An incentive is something that motivates or encourages someone to do something. Incentive schemes refer to the performance linked schemes designed to reward workers for their extra performance and induce them to work harder for the achievement of organizational goals. According to Baruch and Smith, an incentive scheme is a plan or program to motivate individual or group performance. An incentive scheme is most frequently built on monetary rewards, but may also include a variety of non monetary rewards or prizes. Highlighting the importance of non monetary rewards, Alan Pote observes money incentives alone do not bring the desired motivation. Employees in an industry are not economic men so much as they are ego men. What they want above all else is the credit for work done. Interesting tasks, appreciation, approval, and congenial relations with their employers and fellow workers. We will now discuss the features of the incentive scheme. Incentive schemes are designed to recognize the extra performance of the employees and to motivate them to work beyond standards, attract and retain talent. Incentive scheme may consist of both monetary and non-monetary reward.
Let us now consider prerequisites for a sound incentive scheme. Following are some of the important guidelines that should be considered before the introduction of an incentive scheme. Incentive schemes should be in sync with the business and its strategic plans. Incentives should be wasteful if they do not have the desired effect on the organizational goals. Cost and benefit analysis should be done. Incentives are relevant when motivation is the problem, not ability. Thus, it should be ensured that the working condition permits the workers to put in efforts that fetch the better performance. Necessary tools, equipments, training, etc. should be available and the workers should have the requisite control over his work. Role of non-monetary incentives should be recognized. Workers should be able to easily understand the incentive scheme and calculate their rewards at various performance levels. Proper communication of incentive schemes must be done. As Pigors and Myers have put, workers should not have to be a mathematician in order to figure out their pay. In order to get support from the workers, management should install incentive schemes in consultation with the members of a group and their union. Standards set should be scientific, clear, reasonably high, and a parity should be maintained between quality and quantity. As Gary Dessler and Biju Vecchi point out, there should be about a 60 to 70% chance of success and the goal should be specific, thus much more effective than telling someone to do your best. Rewards must be directly commensurate with the results. Incentive schemes must be designed in a manner that it does not put in danger an individual basic livelihood with a limit on the maximum earnings. The scheme should be motivational, it should not result in overexertion. Incentive schemes should not encourage rivalry and non-cooperation among the workers. Often individuals start to pursue the self-interest at expense of teamwork. which jeopardizes the organizational interest. Suitable machinery should be installed to address the grievances of the workers with regard to matters of incentive schemes. There must be a commitment from the top management, and the management must be fair in its dealings on incentive matters, devote enough time and money to assess and administer the schemes.
Incentive schemes often fail because they are not introduced after enough preparations. In most cases, focus is on monetary incentives. Non-monetary incentives like recognition, improves attitude, job satisfaction, and enrichment, etc., also have an important role to play. When workers are paid on the basis of number of pieces produced, they sacrifice quality for quantity. Non-cooperation, rivalry creep in, and workers start pursuing self-interest at the expense of teamwork. Often it is forgotten that there is no substitute for good management. Incentive schemes play their role only when workers are provided with adequate tools and techniques, training, and control over his work. When ability is not a problem, motivational schemes work. Many such reasons result in the failure of incentive schemes. Thus, in order to be successful, must satisfy the above mentioned prerequisites, otherwise that would do more harm than good. We will now study classification of incentive scheme. Incentive schemes can be broadly classified under two groups: financial and non-financial. A financial incentive scheme has an element of monetary transfer attached to it. The monetary transfer can be done to an individual, a team, or it can be done on the basis of the success of an organization to all or most of the employees. Non-financial incentive schemes do not involve any monetary transfer. They are based on the employee's needs or employer support and involvement, recognition of work, reward, opportunity to learn, develop and advance, and flexible working arrangements. Financial incentive schemes are further classified into individual incentive scheme, team-based incentive scheme, organization-wide incentive scheme. First, we will study about various individual incentive schemes. Individual incentive schemes relate individual effort to pay. Popular approaches under this category include incentive plans based on piece rates and plans based on standard hours. Incentive plans based on piece rates. In plans based on piece rates, standard output is per unit terms is fixed. Rate per unit of output is fixed, and calculation for total earnings differ under different plans. Taylor's differential piece rate plan. The father of scientific management, F. W. Taylor, developed this plan. Standard output is fixed and two piece wage rates are laid. One is lower and the other is higher. If the worker's output is equal to or higher than the standard output, he or she gets wages at a higher rate and vice versa. Thus, the plan differentiates between efficient and inefficient workers. When efficiency is less than 100%, wages will be 80% of piece rate. When efficiency is more than or equal to 100%, payment is at 120% of piece rate. The major limitation of this plan is that no minimum wages are guaranteed. An inferior or fresh worker who couldn't reach the standard output could earn very little because of the lower rate. This created a feeling of insecurity among the workers. Merrick's differential piece rate plan. Merrick modified Taylor's plan. He came up with multiple rates. When efficiency is up to 83%, earnings would be the basic piece rate for fresh workers. When efficiency is between 83% to 100%, then earnings will be 110% of basic piece rate for developing workers. When efficiency is more than 100%, then earnings is at 120% of basic piece rate for the most efficient workers. This plan, like Taylor's plan, does not guarantee minimum wages to the workers, but it is more flexible and reduces the severity of Taylor's plan by introducing multiple rates. We have already discussed the incentive plans based on piece rates. We will now study incentive plans based on standard hours. In plans based on standard hours, standard time in terms of hours is fixed for the completion of job and hourly rate is determined. Calculation for total earnings differ under different plans as shown below. Halsey plan. This plan was introduced by F. A. Halsey. A standard time is fixed for the job and bonus is equal to 50% of the time saved. Minimum time wage is guaranteed. It is a 50-50 plan. Both workers and employers each get 50% benefit of the time saved. This, of course, becomes a demerit for the workers as half of the benefit goes to the employer. Total wages equal to time taken multiplied by hourly rate plus bonus, guaranteed time wages. Bonus is equal to 50% of time saved, that is, standard time taken multiplied by hourly rate. Beddock's plan. The special feature of this plan is that the value of time saved is divided between the worker and the foreman in 3:1 ratio. The plan recognizes the contribution made by foreman. If worker and foreman do not cooperate with each other, worker cannot give good results. Under this plan, standard time for each job or operation is expressed as so many minutes called B's or Beddock's points, each B representing 1 minute. If a particular work is rated at 120 Bs, then the standard time for completion of that job is 2 hours or 120 minutes. If time taken is less than the standard time in the terms of Bs, then 75% of the wages of the time saved is paid to the worker as bonus and 25% is paid to the foreman. Rowan plan. This plan was introduced by James Rowan. The only difference between Halsey plan and Rowan plan is with respect to the calculation of bonus. Instead of 50% of the time saved, bonus is calculated as a proportion as follows. Total wages equal to time taken multiplied by hourly rate plus bonus. Bonus is equal to time saved divided by standard time multiplied by time taken multiplied by hourly rate. Total wages is equal to time taken multiplied by hourly rate plus 75% of time saved, which is standard time taken multiplied by hourly rate. For example, standard time is equal to 180 Bs, which is 3 hours, time taken equal to 120 Bs, which is 2 hours, hourly rate is equal to 0.5 per B, which is 30 per hour. Therefore, worker will get 0.5 multiplied by 120 plus 75% of 60 multiplied by 0.5. The plan guarantees minimum wages to the workers. One of the major drawbacks is workers may dislike sharing the bonus with the foreman, which might distort the relationship between the two. Emerson's efficiency plan. The special feature of this plan is that bonus begins at 66.67% efficiency level, which is within the reach of many workers. Bonus is related to the efficiency level, where efficiency level is calculated as actual output in standard time divided by standard output. When efficiency is less than 66.67%, no bonus will be paid, only guaranteed time wages will be given. When efficiency is between 66.67% to 100%, time wages plus bonus increases gradually at 100% efficiency level. Bonus rate of 20% of the time wages will be given. When efficiency is more than 100%, 120% of the time wages plus 1% bonus increase for every 1% increase in efficiency beyond 100% will be paid. Gantt task and bonus plan. This plan assures minimum wages to all the workers. Under it, standard time is fixed for the job and both time rate as well as a high piece rate is determined. Workers are paid at time rate when actual output is equal to standard output and at high piece rate when actual output greater than standard output. If actual output is less than standard output, then no bonus, only guaranteed time wages. If actual output is equal to standard output, then standard time multiplied by hourly rate plus bonus at 20% multiplied by standard time multiplied by hourly rate will be given. If actual output is greater than standard output, then actual output multiplied by piece rate will be paid. Accelerated Premium Bonus Plan. Accelerated Premium Bonus Plan, also known as Sliding Scale Bonus Plan, is not based on any formula. In this plan, for output below standard, guaranteed minimum wage is assured. As the efficiency of the worker improves, the earnings accelerate. The earnings increase in greater proportion to output. Based on this, each firm has to develop its own formula. Worker thus has a strong incentive to achieve higher outputs. This plan is suitable when there is a need to push workers for higher and higher output, but it is not suitable when quality is a concern, not quantity. Barth scheme. This scheme does not guarantee minimum time wages. It is suitable for newly recruited and skilled workers who are already motivated to learn work. Wages under this plan are calculated as time wages equal to hourly rate under root standard time multiplied by actual time.
Slide number 32, Merit Pay. Under the merit pay, also known as merit raise, a high performing employee is rewarded with an increase in his or her basic pay. It is based on how well an individual performs his or her assigned jobs. It is different from bonus and profit sharing, which involve one-time payment without an increase in employees' basic pay. Moreover, bonus and profit sharing schemes depend on the performance of an individual and organization as a whole, not an individual performance. The term merit pay, though, can be used for many employee management, non-management office, factory. The term is generally used for white-collar employees and mainly professional office and the clerical employees. Merit pay links pay with the performance and hence is a powerful motivator. When high performers are rewarded, they set the standards for others to follow. However, merit pay fails to achieve the intended purpose when across the board pay hikes are awarded irrespective of individual merit. In such a case, employees feel that they will be rewarded no matter how they perform. Ineffective appraisal procedures in many firms is another problem. Many a times, the basis of merit pay is seniority or favoritism. This demoralizes the high performers. Thus, while designing the merit pay scheme in an organization, following important points should be considered. The job for which the merit pay is to be awarded is well designed. It should be ensured that the superior is competent enough to define a quantifiable performance criteria, measure the performance objectively, and to differentiate the performance of various employees to determine the deserves of the merit pay. The size of the merit pay must be large enough to impact the performance so that employees can connect the pay and performance. The popular version of merit pay that companies sometimes is a lump sum merit pay, in which instead of rewarding an employee with an increase in her base pay, employee receives a lump sum once in a year which is not added to his or her basic pay. Increasing base pay of the employees also increases the fixed cost of the company on an annual basis. Thus, lump sum merit pay is one program that employers use to reward employee performance without increasing the fixed cost. Lump sum merit pay is also used for those employees whose basic salary has increased the minimum pay for their salary range. Lump sum merit pay is also used for those employees whose basic salary has exceeded the maximum pay for their salary range. मेरे last line.
We will now discuss incentives for salespeople. Some salespeople receive straight salaries, some receive commissions, and most receive a combination of salary and commission. Straight salary plan. It is not an incentive plan. Salespeople are paid fixed salaries. This plan is generally used for new sales representatives who at the beginning of their career spend a lot of time in learning about products and services and trying to build rapport with customers. This plan also allows salespeople to focus not only on the volume of sales but also on finding new clients and cultivating long-term customers. The major drawback of this plan is that pay is not commensurate to performance, which might not motivate salespeople to improve his or her performance. Commission plan. Under commission plan, salespeople have the greatest incentive. More the volume of sales, more will be the pay. If no sales are made, salesman receives no pay. Therefore, in order to earn, one has to inescapably sell. Thus, there is strict proportionality between pay and performance, often resulting in high turnovers as compared to other plans. The main disadvantage of this plan is that salespeople might focus more on the volume of sales and ignore other important duties like cultivating dedicated customers, finding new clients, and pushing hard to sell items. Another potential drawback of this plan is that it does not guarantee financial safety. Combination plan. Salary plus commission. It is the most commonly used form of sales compensation plan, which provides room for financial safety and rewards superior performance. Many companies pay salespeople salaries and offer bonus as a percentage of base pay tied to criteria like meeting various levels of sales targets or other criteria.
Let us now consider the team-based incentive schemes. Team-based group incentive schemes reward all the members of the team equally based on the overall performance of the team members. Gain sharing plans. Gain sharing is a group team-based incentive scheme designed to improve the performance, increase productivity, decrease cost through employee involvement with gains from improved performance shared between the employer and employees. It is based on the assumption that those doing the work can come up with the best and the simplest solution to their work-related problems. Moreover, if the employee is involved in the solution, he will be more motivated and committed to make their solution work. Under the gain-sharing plans, employees create improved suggestions which are presented to the appropriate department level committees. The department level committees does the screening of suggestions and transmits the valuable ones to the executive level committee. The executive level committee decides about the implementation of those suggestions, and once the implemented and resultant savings are shared between the employer and the employee on the basis of pre-established formula. Traditional forms of gain sharing plans are Scan-Low plan, Rucker plan, Impro-Share plan, and with the basic philosophy remaining the same. These three plans differ with respect to the formula employees use to keep a track of the employee generated improvement. Scanlon plan, the oldest and the most widely used gain sharing plan, uses the ratio labor cost to sales or sales inventory. A standard ratio is determined, and if the labor cost falls below this ratio, the resulting savings are distributed between the employees and the employer on the basis of pre-established formula. Rucker plans uses the ratio labor cost to value added, that is sales cost of raw material and supplies. Impro-Share plan compares the labor hours that should be used to produce an acceptable level of output with the labor hours that have been actually used. Much custom designed versions of gain sharing plan exist. One of the important merits of gain sharing plan is to promote a spirit of cooperation and solidarity between the management and employees. Employees feel that they have a say in the organization and their opinion and ideas are being valued by the management. The demerit of this plan is that sometimes rather than doing the job, employees start focusing more on developing suggestions. Successful implementation of gain sharing plan requires the organization culture that supports the drive of performance improvements, teamwork, cooperation, etc. This requires significant commitment on the part of management as well as the employees. The other team-based incentive schemes include Jhawar plan, Priestman's production bonus.
Now we will discuss last aspect of financial incentive scheme organization, wide incentive schemes. Organization-wide incentive schemes reward employees on the success of an organization. These are the schemes in which all or most of the employees can participate and includes profit sharing, bonus and stock related schemes. Such schemes encourage employee loyalty and commitment.
Slide number 38. Profit sharing plan. Profit sharing plan is one in which employer undertake to pay the employees a particular portion of net profits on employees' compliance with certain service conditions and qualifications. The main objective of profit sharing is to develop a sense of belongingness and loyalty among the employees and to foster the unity of interest and cooperation among employees. Employees will work harder if they realize that their efforts may result in higher profits, which will be returned to them through profit sharing. In practice, several types of profit sharing plan exist. In cash plan, the first simple distributes a percentage of profits, usually between 15 to 20% to employees at a regular intervals. Under the deferred profit sharing plans, a predetermined portion of profit is placed in each employee's account under a trust supervision, which is to be paid to the employees at the time of retirement or other stated situations such as disability, death. There exists a combination profit sharing plan in which a part of profits is paid on currently to the employees and a part of the employee's account in the trust fund. Many organizations' specific plans also exist. Profit sharing plans and gain sharing plans are often confused with each other. Though similarities exist, but both are different. Gain sharing is based on performance improvement directly under the employee's control, whereas profit sharing on the other hand is based on the performance improvements, but also on the factors like depreciation, bad debts, taxation, etc., which are outside employees' control. Moreover, profit sharing is annual, half yearly, or quarterly, whereas gain sharing rewards can be given out more frequently.
Bonus. Bonus involves a lump sum pay over and above the base pay and can be distributed as a thank you to employees or a team that achieves significant goals, or it can be specified by a contract, or it can be distributed when the company affords to pay. The basis of deciding the amount of bonus to be distributed varies from company to company. Some establish a fund for bonus after the firm has met a specified level of earnings or has reserved a minimum amount of profits for some specific purpose, like safeguarding stockholders' investments. Some use a straight percentage of company's net profits, and some distribute on a random basis as well. In case the amount of bonus is specified under a contract, then in any case the employer is legally liable to pay the amount of bonus. Stock related plans. Transforming an employee into a stockholder fosters a long term bond between the company and the employee. Employee Stock Ownership Plan. Employee Stock Ownership Plan is a company wide retirement plan developed in the USA in the early 90s. In India, these are not very popular. A trust fund is set up for employees into which companies 1. Contribute cash to be used to purchase its own stock, or 2. Contribute shares directly to the plan, or 3. Have the plan borrow money to buy new or existing shares, with the company making cash contributions periodically to the plan to enable it to repay the loan. In all the three cases, the company contributions are tax deductible with certain limits. Employees pay tax only when they receive the stock at the time of retirement or when they leave the company. Allocations are generally made on the basis of relative pay or some other formula. The plan maintains an account for each employee involved in the plan. As employees gather seniority with the company, they secure an increasing right to the shares in their account. When employees leave the company or retire, they receive their stock, which the company must buy back from them at its fair market value, or if a public market for shares exists, then the employees can sell the shares on the market. Employee Stock Option Plan. Stock option is the option to buy a specific number of shares of the company at a predetermined price within a specific period of time. Under this, shares are allotted to the eligible employees at a price below the market price. It is assumed that the share price would go up in the future and the employees would benefit by exercising this option. Buy at a lower price and sell on the market at the higher price. However, problem arises when the share prices go down and employees see their option go underwater. In such a situation, companies revalue the exercise price as a way to retain the employees. To overcome this problem, companies are coming up with the broad-based stock options in which the potential appreciation is relatively modest and all or most employees can participate. The basic idea is that apart from financial gains, sharing of ownership creates a sense of belongingness among the employees and help to retain them. Employee stock ownership plan and employee stock option plan should not be confused with each other. Two important differences are: firstly, former, unlike the latter, is a retirement plan in which employees receive their stock when they leave the company or retire. Secondly, in employee stock ownership plan, the contribution to the fund is made by the company, whereas in employee stock option plan, Employees are given an option to buy the shares from the company at a price below the market price. Other stock related plans. Other stock related plans include phantom stock plans, restricted stock plans, stock appreciation right, etc.
After analyzing in depth the details of the financial scheme, we should now move on to another aspect of incentive scheme, which is non-financial incentive schemes. Money will motivate some of the people all of time and perhaps all of the people some of the time, but it cannot be relied on a motivation of all the people of all the time, according to Michael Armstrong. Non-financial incentives are those that focus on the need of the people relating to recognition, feedback, responsibility, freedom, achievement, opportunity to grow, and the like. The cost of the employer, little or no money, yet carry substantial weight. Numerous studies have shown that non-financial incentives are particularly effective for those workers who are comfortable with their pay or have been in position for a long time. For those workers, some non-financial incentives are more effective than extra cash related incentives. Moreover, the impact of financial incentives may be short-lived. Non-financial incentives have an intrinsic motivational impact on the employees. Hawthorne studies indicate that in spite of being paid high wage incentive, workers had a tendency to restrict the output although they are capable of producing more. This led to the introduction of the concept of non-financial incentives. Latham and Locke noted that money is obviously the primary incentive, but they have added that money alone is not enough to motivate high performance. One of the most well-known theories of motivation, Maslow's need hierarchy theory, which arranged the human needs into 5 categories in the form of hierarchy, that is from top to bottom: self-actualization needs, esteem needs, social needs, safety needs, and psychological needs, also recognizes the significance of non-financial incentives in employees' motivation. Money is a significant motivator in the satisfaction of bottom 3 level needs. But once those needs are satisfied, the role of money diminishes and the role of non-financial incentive increases. Many theories and contemporary researches have shown that importance of non-financial rewards. Given the economic uncertainty in the environment, non-financial incentives provide companies interesting and creative alternative forms of reward involving lesser cost and at the same time serves as motivational tools for the employees. While cutting cost on incentives, companies should ensure that non-financial incentives do not look cheap to the employees, otherwise they should be breeding resentment.
Opportunity to learn, develop, and advance. This includes paid training, mentorship programs, job enrichment, job enlargement, enhanced decision making, and chance to lead projects. Reward. This includes food coupons, vouchers, gift cards, preferred parking space, etc. Flexible working arrangements. This includes flex time arrangements, telecommuting, ability to stop working on least favorite tasks, compressed work week, and job sharing. Moving on to the types of non financial incentives. Following are some of the popular non financial incentives in practice: employer support and involvement. This includes attentive employers, support when employees commit mistakes, involve employees during decision making, and provide employees the information he or she needs. Recognition of work. This includes award presentation in front of peers, attention from leaders, praise, feedback, upgraded workspace, and dinner with the CEO. We will now discuss how to tailor non-financial incentives. One size fits all strategy cannot suit the contemporary multi-generational workplace. It is important to tailor the incentives to suit the needs of different generations. The younger generation, for example, would focus more on job satisfaction and the work environment than the older ones who would focus more on options to supplement retirement income. We shall now focus on a study by Bob Nelson which explains the differences in non monetary incentives across generations, and these are: mature workers who were born between 1930 and 1945, they require flexible schedules, part-time hours, temporary employment. Baby boomers who were born between 1945 and 1964, they look for retirement planning, flexible retirement options, and training sabbaticals. Generation X, who were born between 1964 and 1981, flexible work arrangements, skill development, feedback, work life balance, rewards motivates them the most. Generation Y, who were born after 1982, they expect flexible work arrangements, employer support and involvement, skill development, feedback, work life balance, rewards from the employer.
Let us summarize what have we studied so far. Incentive schemes are performance-linked schemes which reward employees for their extra performance and encourage them to work harder. An incentive scheme should be designed after considering the prerequisites for a sound incentive schemes. Incentive schemes can be broadly classified as financial and non-financial. Financial incentives can be broadly classified as financial and non-financial. Financial incentives can further be divided into three categories: individual, team-based, and organization-wide. Individual incentive schemes relate individual output with pay and include the scheme based on piece rate, schemes based on standard hour, merit pay, and schemes for the salespeople. Team-based incentives are rewarded to all the employees working in the group and include gaining sharing like Scalon and Rucker. Organization-wide incentive schemes are based on performance of organization in which all or most of the employees can participate like profit sharing, bonus, and stock related plans. Non-financial incentives focus on the needs of the people relating to recognition, feedback, responsibility, freedom achievement, and